Understanding candlesticks. Invented by the Japanese over 400 years ago to get ahead in the rice trade and adopted by wider markets as recently as the 1970s, candlesticks have transformed the way we look at the market today and have massively contributed to technical analysis techniques. Being able to read a candlestick chart is essential when performing technical analysis. Firstly, you need to understand what candlesticks are. A candlestick will show you if the price of an instrument went up or down. You have the ability to see candlesticks over different time frames. Each candlestick chart, regardless of which time frame you are looking at, will show you four things: the high of your chosen time period, the low of your chosen time period, and the opening and closing price of the instrument during that time period. Let's take a look at what a candlestick represents. There are three main things to pay attention to when it comes to reading candlesticks: the body of the candle, the wick, and the body in relation to the wick. The body, or the candlestick itself, shows you the open and closing prices. The colour of the candlestick is important too. If the candlestick is empty, it means the price went up on your chosen time period. If the candlestick is full or white, it means the price went down on your chosen time period. The wick of the candlestick represents the highs and the lows of your chosen trading time period. Pay attention if the body of the candlestick is short and the wick of the candlestick is long, as this shows resistance to a change in price and indicates the market sentiment.